So you want to use the accelerated payoff concept, aka using a HELOC to pay off your mortgage faster, but you realize that you don't have any equity because you may have bought a home using an FHA loan or a VA loan, which oftentimes comes with no money down. And so because you don't have any equity and therefore you can't qualify for a HELOC, does it make it impossible for you to use the accelerated payoff concept? So here in this video, I'm gonna show you an alternative way to use the accelerated payoff concept to pay off your mortgage faster without using a home equity line of credit. By the way, guys, my name is Sam Kwok, one half of the Kwok brothers. I'm a certified financial education instructor, also a real estate investor, and I've been teaching the accelerated payoff concept for nearly a decade here on YouTube, as well as through our financial education company. And being a veteran myself, and I bought a home using a VA loan, I know this is a question that's really dear and close to my heart. So then what is this alternative way of getting a HELOC or to at least start using the accelerated payoff concept? There are two main ways, and I'll break them down for you in this video. Now, the first way is that if you just bought a home in the last year or so using a VA loan or FHA, which in either case, you probably haven't built enough equity over the last 12 months. Furthermore, if you bought your home at a higher interest rate between 2024 and 2025, your interest rate would have been as high as 8%, sometimes even more. So one particular method is to work with a bank that has something called a 90-10 program. And because the rates are much lower now than 2024 and early 2025, a refinance is a consideration that you can make. Now, what even is a 90-10 loan? Well, what a 90-10 loan is, it's 90% mortgage and 10% home equity line of credit. What this allows you to do is that you're able to refinance your loan, which 90% of your total debt or total loan amount is refinanced to a lower rate, and the remainder 10% will basically be a home equity line of credit. So suppose that you bought a home, let's say to keep the math simple, at $100,000, and you did no money down, zero money down as part of a VA loan program. So one particular way is to refinance 90% of what you currently owe into a conventional loan, and let's say 10%, approximately $10,000, is being refinanced into a second lien position home equity line of credit. So you bought a home, let's say at $100,000, and you currently owe about $95,000. The majority portion of that, the $90,000, is converted into a traditional conventional mortgage, and the $5,000 that you owe is being basically refinanced, quote unquote, into a second lien HELOC, whereas you'll have an additional $5,000 of a HELOC limit that you'll be able to use. Now, do keep in mind though that not all banks offer this program, and there are certain states that might not qualify or don't even offer this program in the first place. So there are banks and lenders out there that offer this 90-10, sometimes an 85-5. There are banks that get pretty creative when it comes to breaking it down into a mortgage, a HELOC, a combination. There are banks that do that. Now, the second alternative way is using something called a personal line of credit, a PLOC in abbreviation. What a personal line of credit is, it's an unsecured line of credit, meaning there's no collateral, there's no equity being involved. It simply works like a credit card, and you're able to use it for the accelerated payoff concept. Now, the drawback when it comes to the personal line of credit is that you'll often see the interest rates higher than your typical traditional second lien HELOCs, and the interest rates could be anywhere between 12 to 16%. And many cases, the personal line of credit limits are gonna be much smaller than your traditional second lien HELOCs. Now, the biggest personal lines of credits I've seen personally is $30,000. And in many cases, the banks will give you a personal line of credit anywhere between $15,000 to $30,000, depending on your credit worthiness, as well as your overall finances. But other than that, it works just like a HELOC, where you can take the money from the line of credit, the PLOC, and make a principal payment against the mortgage and take advantage of the average daily balance reduction, and therefore resulting in additional savings. And yes, at the same time, you can take your paycheck and deposit into the personal line of credit, thus reducing the average daily balance. Now, at this point, you might be saying, well, hold on, Sam, did you just say 12 to 16%? Like, how does that work? How are we taking a 12 to 16% line of credit and paying off a mortgage that might be 6 or 7%, or perhaps even lower than that? So just to show you that it is possible, let me show you an illustration. Now, I'm not saying that this is gonna be the case every single time. What I am saying is that it is possible to use a personal line of credit to pay off your mortgage faster, particularly if you have a VA or an FHA loan, whereas you may not be qualified for a traditional second lien position HELOC. So just to paint the numbers, we have $300,000 as the original balance on the mortgage, $295,000 just to illustrate the fact that you don't have much equity, 6% interest rate, and our P&I, principal interest payment, is $1,798.65. All right, just for simplicity, we're not going to add any additional consumer debt, credit cards, or anything like that. And we're going to assume that we start October 1st, 2025, with a paycheck of $10,000 that hit our bank account every month and living expenses of $7,000 and a cash flow of roughly $1,200 a month. And we're gonna use a $10,000 chunk on a 15% personal line of credit interest rate. So there it is, right? The interest rates are gonna be much higher than your typical second lien position HELOCs, and of course, much higher than your mortgage rate of 6%. So almost, more than double, of course, the interest rate on the personal line of credit. So if you scroll down to the potential results, right, we're still able to save some money, right? So we're able to pay this off on Friday, January 16, 2037, which is about in 11.3 years. Our original interest would have been $323,524. But because of the accelerated payoffs concept, using the personal line of credit, we're able to pay just $119,552, which represents a saving of nearly $203,000 of interest cost along the way. Okay, and we went from 108% total interest percentage down to just 40, which represents 68% of interest savings that we were able to accomplish using a personal line of credit. Now, would you get perhaps better results if you had a second lien position HELOC? Sure, right? If you were to, let's say, bring this down to 6.5% for our second lien HELOCs, right? Okay, the results are gonna be slightly better, but you'll notice it's not a drastic change, right? So again, let's go back to that 15%. All right, 15%, there we go. Okay, 11.3 years, all right? We'll pay slightly more interest. Okay, we'll save about $203,000. But if we go back to, let's say, a 6.5 on a second lien, okay, there we go. We'll get a little bit more savings, right? Approximately, I think, $10 more thousand of savings, which is good, right? But it's not this big marginal, big massive change that, one might expect. So yeah, even with the 15% personal line of credit, let's even go to 16%, right? 16% personal line of credit, you're still able to save quite a bit of money, gives you the flexibility that you need just in case of an emergency, and you're able to pay this off quite fast. What I'm trying to show you is that it's not impossible, that it is possible to save money and time using a personal line of credit, especially if you don't have any equity to get started, whether you bought a home using FHA or even a VA. Now, is it possible once you have more equity, once you've paid down a considerable amount on your mortgage, could you then get a second lien position HELOC? Sure, barring, if you don't have any other issues like credit score issues or debt to income ratio issues or cash flow issues, yeah, you can still get a second lien position HELOC or even a first lien position HELOC if you're able to get a better rate. But to get started on the accelerated payoff concept, no, you don't need to get a HELOC to get going. You can use a personal line of credit. And like I mentioned earlier, there are other creative programs like the 90-10 or the 80-5-5 or 80-10-10, I should say. There are other programs that are available that you can take advantage of to get the process started. And then you may end up being in a HELOC or you may not. You might say, hey, I like the PLOC option. I'm just going to stick with it. So this whole myth about having to have a HELOC to do this concept, it's not true. There are other lines of credit you can use. I have a few number of clients that are using a brokerage account line of credit, meaning they got a line of credit that's collateralizing their brokerage account, right? Their stock portfolio. And they're able to use that instead of a home equity line of credit. So there are other types of line of credit that you can get your hands on that could be compatible with the concept and yield to savings in time and money. So if you have any questions, if any part was confusing or you're still not getting something, leave your comments down below. I'd be more than happy to answer them. Or if it warrants a separate video, I'd be more than happy to make it. So leave your comments and questions down below. With that being said, check out some other videos that we have in our channel. And if this is your first time with us, be sure to subscribe, like the video for the algorithm, and we'll see you in the next video.